So in this section, we will look at the foreign exchange market. So this is chart number 26, Euro USD weekly. So as you can see here, these are not the Bollinger Bands. This is the Donchian channel. Okay, remember I taught you the concept of Donchian channels. We discussed 20 different videos on that concept. So question number 1, why would you go short on this candle? Number 2, what would be a cause for concern if you went short on that candle? Number 3, how and why would you go long on this candle, this green one? Number 4, in this downfall, the middle line of the Donchian channel is likely to become what? Fill in the blanks. Number 5, why would you not go short on this candle, this red one? Number 6, why did the low of this candle held as support for almost a month? This green candle. Number 7, spot the shaven top, shaven bottom candle on this chart. Question 1, why would you go short on this candle? So first, this is a shooting star. Second, it's confirming the high of this shooting star. And the price is near the upper band of the Donchian channel. So that is the reason why I would go short on this candle. What would be a cause for concern if you went short on this candle? So if you went short on this candle, what would be a concern? The concern would be this green candle. See, this green candle satisfies our criteria for a long white or green real body. And we know when that happens, the low of that candle becomes support. So if I'm going short on this candle, I'm going short near support. Sometimes the 50% level of this candle can also become a support. It does not matter whether that candle comes in an uptrend or a downtrend. Number 3, why, how and why would you go long on this candle? So if I were to go long, okay, on this candle, first it has to confirm some prior support, only then I would go long on this candle. And how would I go long? Well, since the candle is large candle, the reward to risk on this spread is going to be low for this bullish engulfing pattern. And we know that to increase our reward to risk, what we have to do is to draw a Fibonacci level. See, this becomes 100% level. And the low becomes a 0% level. And maybe you put the order either at the 61% level or the 50% level. Wherever you put the order, you get filled on this candle and the price continues to go upward. So that's how I would trade that candle. Number 4, in this downfall, the middle line of the Donchian channel is likely to become what? In a downfall, just like in Bollinger Bands, the middle line, the price is likely to remain between the middle line and the lower line of the Donchian channel during a downtrend. This is exactly what happens in Bollinger Bands as well. So the middle line is likely to become resistance. Number 5, why would you not go short on this candle? So if I look at this candle, it's completing a bearish engulfing pattern. It's not completing a evening star if you observe these 3 candles carefully. But anyways, it's completing a bearish engulfing pattern. However, it's not testing this high. That line is still above the high of the bearish engulfing pattern. So the bearish engulfing pattern is not testing that high properly. So there is a chance that the price may go up and test that high and then fall down, which is exactly what has happened here. Correct? So wait before you take a trade. Always wait for the price to properly test it. If the shadow was like this, then it's a proper test. Correct? Then I would have gone short on that candle. Number 6. Why did the low of this candle held as support for almost a month? So if you see, it's a weekly chart here. So this is 1, 2, 3, 4. And on this candle, that support was broken. So almost 3 weeks to 1 month, the low of that candle has held as support? The answer is simple, right? The candle satisfies our criteria for a long white or green real body, and we know that the low of that candle becomes potential support. Spot the shaven top, shaven bottom candle on this chart, or shaven head, shaven bottom candle on this chart. So you look at this candle, there is hardly any upper shadow, hardly any lower shadow. That's a shaven head, shaven bottom candle on this chart. So this is chart number 27, the US yen daily. So question 1, what is the problem with this breakout at this candle, the breakout of the box range? Number 2, this candle comes after an uptrend. Is it a bearish belt hold line, and why? This red candle. Number 2, if this candle had not closed near resistance, then what would be the target on this buy trade? Again, the same candle. Number 4, what did this candle fail to confirm? This red candle. Number 5, why should you take notice of this high wave candle, this particular high wave candle? And I have given you a hint here. I have drawn an angled trend line by joining these 2 points, this high and this high. Number 6, this candle breaks the angled trend line. Should you buy? So you have a break of the trend line. And number 7, this candle confirms the break of the angled trend line. Should you buy? So on this candle, you receive confirmation of the break of the trend line. So should you buy there? So question 1, what is the problem with this breakout? So that candle is a breakout candle. However, the problem is it has still not closed above that resistance. Number 2, this candle comes after an uptrend. Is it a bearish belt hold line? The answer is no, because a bearish belt hold line will be like this. It will come after an uptrend and it will look like this. Here it's the reverse of this black candle. So that's not a bearish belt hold line. Number 3, if this candle had not closed near resistance, so if this candle had not closed near this resistance, then what would be the target on this buy trade? So the question is, if this resistance was not there, then what would be the target on that trade? So how do you measure the target? You have this box range, so you take this price. The price has broken out of that box range, so you project that same distance upwards like this, and that becomes your target. So near this level, and that target, as you can see, is achieved within a few candles, right? So it took so many candles to complete this particular height. But when the breakout happens within just 3 candles, that height is achieved. So breakouts are very powerful signals to trade, especially for momentum traders. Number 4, what did this candle fail to confirm? So this candle is failing to confirm the bullish implication of the last engulfing bottom. This is a last engulfing bottom, and this candle is failing to confirm that bullish implication. Number 5, why should you take notice of this high wave candle? So I have drawn an angled trend line here just to give you a hint. So I have joined these 2 highs. One is this high and one is this high. So when I join those 2 points, I get an angled trend line. And this high wave candle, it confirms the angled trend line as resistance. So that is why I would take notice of that high wave candle. Number 6, this candle breaks the angled trend line. Should you buy? See, just because the candle has broken the trend line doesn't mean that you go out and buy, because you also look at other factors in the market. You have resistance here, you have resistance here. So if you are buying directly into resistance. So it would not be wise to buy on that candle. and see what happens after that. The price goes down. Number 7, this candle confirms the break of the angled trend line. Should you buy? So after this candle, you want to see whether the price sustains above that candle, right? And this little candle has confirmed that the price is likely to sustain above that trend line. But is that a reason to buy? No, because again, you still have resistance here, which is tested. You still have resistance here. Plus, it's a tiny little candle. You don't initiate trades on such candles, okay? So I have drawn the Fibonacci levels here. This is chart number 28, the British Pound weekly. Question 1. On which candle have I drawn the Fibonacci levels and why? Number 2. On which candle would you put a buy limit order based on the Fibonacci levels and why? Number 3. Based on the buy limit order of the previous question, what are your 2 potential stop levels and why? Number 4. Based on the buy limit order of the previous question, what are your potential target levels? Number 5. Is that an ideal dark cloud cover and why? This one. Number 6. If you see 6 spinning tops in a row, what would you expect the market to do next? So these spinning tops. Spot the 3 white soldier pattern on this chart. So question 1, on which candle have I drawn the Fibonacci levels and why? So I have drawn the Fibonacci levels on this green candle. It's completing a bullish engulfing pattern. It's confirming this support created by that variation of a piercing pattern. So I have drawn the Fibonacci levels here. So this is the 100% level. This is the 0% level. And the reason why I have drawn the Fibonacci on this candle is because it's completing a pattern. And I want to buy on that candle by increasing my reward to risk. On which candle would you put a buy limit order based on the Fibonacci level? So it's this candle. And the buy limit order would be either you buy on the 61% level or the 50% level. You can choose whichever you are comfortable with. Generally, I have seen people put a buy limit order on the 61% level. So that would be the candle. Number 3, based on the buy limit order of the previous question, what are your 2 potential stop loss levels? So where would you put your stop loss? So let's say you put a buy order here. One of your stop losses can be 38.2 because when the price retraces, it will not retrace beyond that 38% level. So that would be a potential stop loss level. And of course, this is another stop loss level, the low of the bullish engulfing pattern. So this one and this one are your potential stop loss levels. Depending on which one you choose, you are choosing your reward to risk ratio. Number 4, based on the buy limit order of the previous question, what are your potential target levels? So if you put a trade like this, so your entry is here, 61 level, your stop loss is 38 level, and 1.61, generally that is taken as the target. So that's your target. So now you have a proper 2:1 or more than 2:1 trade here, correct? And look what happened. Your order gets filled here, 1, 2. That's it. Within a couple of candles, you have achieved a around 3:1 trade within a couple of candles. Okay? So that is one target level. Second target level is this. So if you don't want to keep this as your target level, you can keep this as your target level. Only thing is that you will have to wait a couple of candles for your target to achieve. Or you could choose this level, keep your stop loss here. That would be your target. I think that is again a 2:1 kind of a trade, right? But you look at the Fibonacci, it is very powerful. It keeps your stop loss small, gives you a higher reward to risk ratio. And it meets your target quickly as well. Is that an ideal dark cloud cover, and why? It is not an ideal dark cloud cover. For an ideal dark cloud cover, the opening of the red candle should be above the high of the prior green candle. Number 6. If you see 6 spinning tops in a row, what would you expect the market to do next? So if you see a price action like this, that's a box range, right? So the price is going up, then you have a box range. And most likely, as we discussed earlier, the prior trend is likely to continue. So if the price breaks this box range, right, then the price is likely to go up from here. Spot the 3 white soldier pattern on this chart. So we know that the 3 white soldier pattern comes after a downtrend. So let's look at a downtrend. 1, 2, 3, but you have a spinning top, so this is not a 3 white soldier pattern. What about these? There are only 2 candles here. That's it. There is no 3 white soldier pattern on this chart. So this is chart number 29, the US franc daily time frame. I have drawn the MACD here. Question number 1, would you buy on this candle and why? So this green candle. Question number 2, if you sold short on this crossover, where would you exit the trade? So you can see a crossover here, the blue line and the orange line. Number 3, when the fast line is below the slow line in MACD, what does it indicate? Number 4, after this box range, the price is most likely to break out. And what? So you have to fill in the blanks here. Number 5, why would you not be surprised to see a bullish engulfing pattern in this area? So this pattern. 6, give 2 reasons not to go short on this candle and 2 reasons to go short on this candle. So this red candle. Number 7, is this doji of significance in the context of this chart? So this doji candle. So question 1, would you buy on this candle and why? So let's look at the scenario here. First, it is completing a bullish engulfing pattern. That is great. Second, if you look at the MACD levels, the histogram has ticked up. It has gone from this to this, so dark red to faint red, which is a good sign. And is it confirming a prior support? Well, this, if you look at this candle, that candle satisfies our criteria for a long white real body, right? So when that happens, the low of that candle becomes potential support. We also know that the 50% of that 50% level of that real body also becomes potential support. So if you draw this line, you see that the bullish engulfing pattern is confirming that 50% level. So a bullish engulfing pattern confirming prior potential support and the histogram ticking up, I would buy on that candle. Number 2, if you sold short on that crossover, where would you exit the trade? So this is classic MACD. So there is a crossover here, right? Say on this candle. If you sold short there, where would you exit? So you look for the next crossover. So it comes here somewhere on this candle, right? This or this candle. So wherever that crossover comes, I would close my position. So going short here and covering the position here. If I cover the position here, I am making some money, correct? However, if I cover the position here, I don't think there is money to be made. So one candle makes a huge difference. But it's not the candles that are important for this question. What's important is how you navigate the crossovers. So when the blue line goes below that orange line, so that's a bearish sign, right? The blue line is the most volatile line. So that's the slow line, that's the fast line. So you wait for the next crossover. So MACD is a lagging indicator. When the fast line is below the slow line MACD, what does it indicate? It indicates that the market is bearish. Number 4, after this box range, the price is most likely to break out and go up. Why? Because See, the price goes up, then it goes flat, and then it is most likely to go up if this resistance breaks, okay? Generally, box range movements are like this, like 1, 2, 3. And if it's going down, then 1, 2, 3. That is how box ranges move. Number 5. Why would you not be surprised to see a bullish engulfing pattern in this area? Obviously, right, the midpoint of this candle is a potential support area, and the bullish engulfing pattern is coming at that support area. So that's why I would not be surprised. Give 2 reasons not to go short on this candle and 2 reasons to go short on this candle. So let's first look at the 2 reasons why I would not go short on this candle. So the first reason is, of course, you look at the reward to risk here. So if you go short here, this would be a stop loss and that would be your target. So that is not a 2:1 trade. So that is the first reason I would not go short on that candle. Second, see, this is not confirming this high, right? So chances are the price might go up and test that high before falling down. So that is another reason why I would not go short on that candle. And 2 reasons to go short on that candle. Then see, we have to now discuss 2 reasons why I should go short on the candle. So one reason is, if you look at this, is a dark cloud cover, right? Variation of a dark cloud cover. So that's getting confirmed here. So the bearish engulfing pattern confirming the prior resistance area. That is one reason. Second reason is, if you look at this black candle, it satisfies our criteria for a long black real body, right? Which is very, very bearish. That's another reason I would go short on the candle. There is a third reason I would go short on the candle, is because if you look at these 2 candles, it's a perfect bearish engulfing pattern, right? The first candle is small, the second candle is tall. The reason why it's not a complete bearish like this, it's not completely engulfing, is because it's a currency, it's a Forex chart, right? On a Forex chart, it's a 24-hour market. So for 24-hour markets, you will never get one candle engulfing the other candle. See, if you look at these 2 also, the close will be open here and the close will be open here, right? Because it's a 24-hour market. So those are the 3 reasons why I would go short on this candle. And when you get conflicting signals like this, the best thing to do is to do nothing. Number 7, is this doji of significance in the context of this chart? You look at this doji, of course it has got significance. Why? 2 reasons. One reason is it's coming near this 50% level, right? That is one reason. Second reason, if you look at these candles, 1, 2, 3, 4, 5. 5 consecutive red candles. And suddenly you have a doji. What does that tell you about the market? It tells you that the prior trend is likely to end. Next, chart number 30, USD Canadian dollar, weekly time frame. Again, we have the MACD here. Question 1, is there a bullish divergence on this chart? Question 2, does this hammer also complete a bull harami? Why? So this candle. Number 3, if you buy on this hammer, how would you manage the trade using the MACD lines? So again, the same candle. Number 4, what is another name for this kind of hammer? Number 5, why would you not buy on this hammer? Number 6, is that an inverted hammer and why? So this candle. Number 7, can you spot the change of polarity on this chart? So question 1, is there a bullish divergence on this chart? So for a bullish divergence, what do you need? So if you look at this is the MACD, you look at this low, and this low. This low is above this particular low, correct? So, and that low appears near the hammer. So at that hammer, the histogram has ticked up. Okay. So the MACD histogram is going up. Whereas if you look at the price, this and this price has gone down. So when price goes down and the MACD goes up, that's called a divergence. So you have a bullish divergence on this chart. And remember, one critical condition to complete a bullish divergence is between these two areas, between these two troughs, there should be this green histogram candles. So the histogram should cross that center line before that second trough is formed, right? If there are no green histogram lines here, then this is not a bullish divergence. Always remember that. And see how powerful that bullish divergence was. After this hammer, the price is never looked back. Okay. Number 2, does this hammer also complete a bull harami, and why? The answer is no, because if you look at these two candles, that's not a bull harami. Like, it looks like a bull harami, but if you look at the height of the two candles, it doesn't satisfy the criteria for a bull harami, because the height of this green real body is not less than 20 to 25% of the height of this prior black real body. Number 3, if you buy on this hammer, how would you manage the trade using the MACD line? So let's say you buy the hammer, okay? Generally, when you buy on the histogram, the crossover is going to come after a delay of 2-3 candles, right? Because MACD is a lagging indicator. So you buy on this hammer and you have the crossover here, which means that the market is bullish. So you wait till the next crossover happens. So the next crossover happens somewhere over here, say. I don't think that's a crossover. Even here you don't see much of a crossover. So there is no second crossover here. The blue line continues to remain above that orange line. So you would continue to hold this market till the blue line crosses below that orange line. Okay? That's how I would manage that trade. So that's how powerful the MACD lines are that tell you to remain in the trade. What is another name for this kind of a hammer? It is called as a power line. Okay? Number 5, why would you not buy on this hammer? So a reason why you would not buy. We have looked at reason to buy, but why would you not buy? The reason why you would not buy on the hammer is because not confirm. It doesn't look like it's confirming some prior support level. Okay? That is also very important. Number 6, is that an inverted hammer, and why? See, inverted hammer comes after a downtrend. So this is a downtrend, I agree. If you look at the price in that way, then that's an inverted hammer. However, you carefully observe this is a weekly chart, correct? After the price stopped at this doji, from here to here, the price has been in a range. So that is the reason why I would hesitate to call it a inverted hammer, because it's a weekly chart. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. For 10 weeks, if the market is flat, how can we call this candle as a inverted hammer? Correct? Can you spot the change of polarity on this chart? It's very simple, right? You take this support area, the candles are stuck here, and you draw the line. See what's happening. So that support has become a resistance area here.